Thanks for joining us again on another episode of the Exploring Mining podcast. Today I have Peter Krauth, a frequent guest on my show, and also the writer of The Great Silver Bull and newsletter writer for Silver Stock Investor. Silver Stock Investor is the only investment newsletter focused exclusively on silver. We talk about China, Russia, inflation, and forecasts for silver prices into Q2 of 2025, plus 2 juniors worth taking a look at. We also discuss upcoming conferences in Vancouver in 2025, including the Cambridge House VRIC 2025, held January 19th and 20th at the Vancouver Convention Centre. Links below and throughout the show to register for investors. As a reminder to investors, please read all disclaimers and disclosures at the end and the beginning of the show, and as a reminder to please do your own due diligence. Peter, thanks so much for joining the show again today. You're always one of my favorites. Let's just dive right in. We have some big news from Russia, China, Trump. Do you want to walk us through what you're seeing in your perspective?
I guess for me, because I'm a silver guy, some of the biggest news I've had in the last little while. So some of it's maybe, a month ago, and then there's a little bit more that's a few days ago, and it's regarding Russia in particular. So about a month or so ago, maybe a little more, Russia said that it was going to start adding precious metals to its national reserves. So we're talking about gold, silver, and some platinum group metals like platinum and palladium, maybe even rhodium. That's going to mean that we're going to see less of these metals coming out of Russia. They're going to buy them and keep them internally. And then just a few days ago, there was a headline about how Russia was now banning, starting December 1st until May 31st, they are now banning the export of scrap precious metals. Now, these could be metals that are mixed with other things. In other words, it could be in electronics or whatever may be. But if there are precious metals that can be extracted along with other metals in this so-called scrap, then it's going to have to stay at home. It's going to have to stay domestically in Russia, and they want to use it to help supply their own consumption of those metals. So, you have to ask yourself, well, what is the impact? Is Russia, a big enough supplier of these things? Well, if they're starting to do it, if they're starting to buy from two perspectives or from two angles, one, just the actual production of the metals, the pure metals to keep for their own reserves, and they're limiting the export of the scrap metals, that's going to start to add up, and it's going to also send some signals to other countries around the world that maybe you're not so sure how friendly they are with some of the West.
Really, we're still at this supply story, demand story. So what do you think is how much do you think this will even impact the prices of silver going into 2025? Because we don't have the supply.
No, exactly. The Silver Institute has said that we can expect that we're going to have about according to them, a 215 million ounce deficit this year. That's about a quarter of the annual supply, which is, about 20% of the annual supply, which is about 1 billion ounces, where about 85% or so comes from mining and about 15% comes from recycling. So that's quite the deficit for 1 year. And if you add up the last 4 years, including 2024, with the forecast of 2024, we're looking at close to 800 million ounces of deficit, cumulative deficits for these last 4 years, which is 80% of 1 year's supply. You can only go on for so long, obviously, for obvious reasons. I think operating on a deficit, you have to ask yourself, well, how does this even happen? How can a market operate on a deficit? And just to kind of maybe sort of explain it very quickly, there's supply, which is mining and recycling, about 1 billion ounces. And then there's demand and consumption overall, which is 1.2 billion ounces. So obviously, demand exceeds supply by 20%. What's happened is in the last 3 years or so, the big consumers have tapped into what we call secondary supplies. These are above ground inventories of silver that are mostly found in the futures exchanges, like the COMEX, the Shanghai, and the LBMA, and as well in silver ETFs. So on average, these three or four, stockpiles are down about anywhere from 40 to 70% in the last 3 years. And I've been saying since earlier this year, and there was an interesting report by TD that basically said the same as me. This goes back to about April of this year, that they only see 12 to 18 months of this, lasting. And then, all bets are off. We're gonna have drained completely these secondary supplies. So there is a wild card, and the wild card is private ownership of silver. So it's very, very difficult to know with much precision how much there is of these private hoards of silver. And the argument tends to be, well, if the silver price moves up enough, some of this will be dishoarded. It'll come to market and it'll help meet supply. And I would say I would agree to a point. I think we're in the kind of economic environment where it's going to take much, much, much higher silver prices for not all, but I would say the majority of those silver stackers who are very patient to actually let go and sell some of that silver into the market. So I would certainly not count on that for much supply. And Cali, if you'll indulge me one more little rant, there was there's a guy out of New York by the name Leigh Goehring, and he ran one of the world's largest uh, commodities funds a few years back, and he basically so this is a really smart guy. He knows what he's talking about managing commodities and what the market's like and what pulls and pushes on the market. And he said, I'm going to read this. He said 5 years ago, and bear with me, I'm talking about uranium at this point, but you'll see where I'm going with it. He says, 5 years ago, we became uranium bulls. The market had quietly slipped into a structural deficit with reactor demand outstripping mine supply. Fuel buyers used so-called secondary supplies to fill the gap. So I'll ask you, Callie, what does that sound like to you?
It sounds like the entire commodity market now.
Well, yes, that's true. But I make silver parallels, and this is essentially there's more demand than there is supply, and the consumers, the big consumers, are tapping into so-called secondary supplies exactly like they did with uranium. So they became uranium bulls 5 years ago. And so what happened in uranium since then? Well, in the last 3 years, it's gone from about 25 or $28 to over $80. And it's stayed very much since then in the range of about $80. So it essentially tripled and stayed there. So, I mean, we have the exact same setup in silver right now. I think this is a really, really good parallel for what is likely to happen in silver.
You just kind of alluded to it. Some of the what's going on with China, because I mean, solar again is not going anywhere. That demand just keeps going up. And now again, with these tariffs, trade wars, and everyone fighting with each other, for
That's right.
lack of better words.
Right.
How do you think that between the US even and China, just as those two large countries, or how is that going to play out, do you think, again, for silver prices?
I mean, you can look at the China side. There are two ways. Obviously, there are two sides to this. You can look at China and say, well, if the U.S. imposes all these tariffs and duties, especially on China, and they're the largest solar panel manufacturer, that's going to eat into their market. It's going to make their panels a lot more costly. So there's that side of it, but then you can't underestimate that China will do two things, I think. They're having some trouble. It's not a secret. They're having some trouble economically right now. Real estate is not doing well, and things are slow in terms of growth. In fact, GDP growth. So a little while back, I think about a month or so ago, they pulled out all the stops with a massive stimulus package. We'll have to see if that has an effect. But I would not bet against them even stepping up that kind of stimulus even more. I can see them pivoting to the rest of the world that isn't going to be such a stickler about imports from China. And especially if they maybe start discounting, perhaps just because they need need some big markets to sell their solar panels to, that there, it could certainly affect solar panel demand, but there are some counterweights to that. One of them is that there's a big shift in technology. And so the previously, I guess at this point, you could call it previously established technology in solar panels was something called PERC. It's an acronym. Don't ask me what it stands for. But that was the established technology. And we are now very quickly, this year, if I remember correctly, have already shifted to new production of solar panels being about 80% this year out of China, and they're 80% of the market. So about two-thirds now of solar panel production will be using this newer technology. Again, an acronym, which is TOPCon. And this technology requires up to 50% more silver per panel. And so they use this technology because the panels are more efficient. So if you look at the silver market and you say, or the solar panel market, and you say, maybe if things go bad globally or in China at least, and it slows down, and let's say there's no growth. Let's say panel production is flat. There is still the point that panel production will require more silver per panel. And so there is this new technological demand aspect for solar that I think is not being factored in. So, there, like I say, I don't want to be sort of all bullish and say there are no concerns or no risks. There are, but I think they need to be tempered. And if you look at what's really going on, you'll realize that there are things that I think are not being accounted for. And here's an interesting stat. I came across this not long ago, where the research was done to look at solar uh, solar installations in terms of forecasts. So if you look at forecasts for the number of solar installations and you look at the 5-year out forecast, well, this research showed that if you took the average of the forecast from the International Energy Agency, the Energy Institute, and Bloomberg NEF, their forecasts on average were too low by a factor of 3. In other words, the 5-year forecasts, or the actual installations, if you looked 5 years out from what was predicted 5 years earlier, it was actually 3 times the level of solar panel installations that was actually predicted. So we tend to produce and install a lot more solar than has been expected in the last sort of 10 to 15 years. It's just really been off the charts. And then there are all sorts of other things that that influence this as well. You've got demand from data centers, driven in a large part by AI. AI itself doesn't only demand electricity and storage of the data, but a chat GPT query takes 10 times more energy to get the answer to than a Google search. So we've got this big shift to AI right now, and just that in itself is going to require a lot more energy. So I mean, I could go on forever talking about this stuff.
I wanted to go into the inflation story because, people, again, maybe some is the younger generation that has not seen the inflation rates that we're going through, obviously in their lifetime, or they were very, very young and don't remember, didn't have any bills.
That's right.
But obviously, people are feeling optimistic because, we've seen interest rates go a little bit down. Can you talk a little bit about what your perspective is or what your forecast is for inflation? Because I don't feel like we're going back to where we
Yeah,
were.
I completely agree with that. And it's interesting. You've got the Fed and other central banks cutting rates, and yet the larger economies are nowhere near this sort of universal 2% target. We're still really much closer to 3%, and yet they continue to cut. I don't know about you, but I have not seen the data that shows that we're clearly they'll say it. They'll go out and say it, and the Fed governors will go out and they'll say, we see that we're clearly on track, towards 2%. Um, Again, I have not seen it, and yet they keep cutting. Um, and just think about this. We've talked about Trump as the new president starting in January. He's talking about he's putting tariffs on Canada, Mexico. He wants to up tariffs on China. He wants to deport illegal immigrants. So let's look at these. First of all, what are trade tariffs going to do to imports? Well, it's going to push them up. It's going to lower them. It's going to lower imports. Obviously, you're going to have U.S. Buyers, consumers of all kinds, industrial and retail consumers, are going to look for other products that maybe compete with these higher priced items because they've had these tariffs slapped onto them. But you can't do that for everything. Some things the US doesn't produce or doesn't get, or even with the tariffs, they might still be cheaper. So that's just going to push prices up domestically for the US. And then the second thing is, I talked about deporting illegal immigrants. Well, guess what? Illegal immigrants perform a lot of the jobs that are paid lower wages. So what's going to happen if they're not available anymore to fill those jobs? Those jobs are going to have to be filled. Many of them won't get filled. So that's one aspect. The other aspect is if they do get filled, they'll get filled by Americans that are there, that are in the US legally and want those jobs. But because there are fewer people available, they'll have pricing power. So they can start pushing for higher wages. Again, guess what? That's going to push inflation higher. We saw this before. None of this is new. This happened in the 1970s. And in the 1970s, there were three big waves of inflation. And in fact, I've got charts where these line up almost perfectly time-wise in terms of the number of years that they took to play out. And I have one chart that shows that this first wave, that one that happened in the late 60s and early 70s, it ran up. What happens is you get central banks, step in, people start screaming about inflation, the central banks step in, they start raising rates, and the economy cools and the rates come down. Sorry, inflation comes down. Well, it comes down, but it never comes down to the pre-inflation levels, which we know, say prior to 2019 or 2020, were almost at zero in some cases. The Fed, eventually got really hard what it said it wanted so badly, which was inflation at 2%, eventually went to 9%. So what happened in the 1970s was, as I say, and as we've just experienced, central banks start raising rates, it cools the economy, the inflation sort of dials back, but it does not dial back to levels that were pre-inflation or pre high inflation. It dials back, but it reaches a new trough that is higher. So in other words, right now, what I'm seeing is that we've seen inflation kind of pull back to about the 3% level. I think that the 3 to 4% range is going to be the new 1 to 2% level. I think these are going to be the new lows. And what happened in sort of the early part of the 70s was you had this trough, and then you had things like we just talked about. You had tariffs, you had higher wages, and these started to push inflation back up. And The second wave of inflation peaked at a higher level than the first wave. So we're lining up for that as we are right now. And it's likely that, based on sort of the timing of what we saw in the 70s and how this is lining up, I think we're going to see a bottom in inflation, and for it to start to trend upwards probably by the second quarter or early third quarter of next year. So inflation is not gone. Enjoy, if you can, the rates that we have now. I think this is about as good as it's going to get. It's going to go considerably higher, and look for that starting by around the middle of next year.
Wow. Well, I don't feel super happy about that.
Yeah, neither do I. I just kind of calling it as I see it.
But on the positive flip side, great for commodities. Obviously, the hedge against inflation is assets and commodities. I kind of feel like silver, for again, the younger generation that's not used to this, is like the gateway metal into getting into commodities. So, can you just talk a little bit to investors that are new to this whole scenario of how silver can be a great hedge against what's the second wave coming that you just talked about?
Sure. So, Kelly, first of all, I love your term there of gateway metal. I think that's fantastic. I'm gonna use it. So
Please steal
I'm already
it.
I'm already telling you now that I'm gonna use that. It's too good. So yeah, I mean, if you look at silver, it becomes the natural alternative to gold, and everybody knows gold, and even people who maybe, I shouldn't say everybody, but a lot of people know and understand gold, even some of the younger generation, what its purpose is, and it's very little of it is used in industry, so most of it is an investment, and most of it is both a safe haven and a protection against inflation, and it does that job. And I'm going to say in some periods of history of time better than in other periods. Well, but when it does it and it does it well, you definitely want to own it. And I'll give you a little example. If you look at what happened in late 2022, the so-called, 60/40 portfolio of 60 stocks, 60% stocks, 20% bonds, because inflation ran up so high into mid 2022, that portfolio had its worst returns in something like 100 years. And so Wall Street loves to tell everyone, this is the standard, this is what you should own, and this is how you need to split your assets, and if you have a long-term view, and on and on and on. But that, I think, is unlikely to be the case over the next 10, maybe 15 years. And in fact, you've got banks, big US banks like JP Morgan, saying things like, that are agreeing with that. And they're saying things like, bonds are really, really going to struggle. I mean, if you just understand quickly that bonds um, move inversely with interest rates. So if interest rates move up, bonds that already pay a certain coupon will compete with higher rates. So they will go down in value because you can get a better return in a newly issued bond that now pays a higher return because interest rates are higher. So just understand that it moves inversely to interest rates. So if inflation continues to move higher, bonds will continue to struggle. So, and banks like JP Morgan and others see this, and they're saying that, maybe your bond portion of your 60/40 portfolio needs to be readjusted. Maybe it shouldn't be so bond heavy. If anything, if it's going to be bonds, it needs to be a smaller portion than 40%. It probably should be closer to maybe 10 or 15%. It should definitely be short-term bonds, which are less affected, and you can renew them at higher rates as rates go up. So you've got that advantage. And for the balance of that 40%, you really should be looking at hard assets. You need to be looking at commodities, and in fact, the entire commodities complex. So I would completely agree with that. I think we're going into, a decade or more of a very, very powerful bull market in commodities. And so that's where people need to have some focus. I even have my doubts about the 60% stocks part of the portfolio, but let's leave that aside for now. to get back to silver, you talked about, the gateway to investing in resources and precious metals in particular. Well, silver does well and it outperforms gold in bull markets, but it tends to do that more later in the length of these super cycles, bull markets, these secular bull markets. And part of the reason is that people will turn to gold first, and gold will perform well. It'll get most of the attention, and it'll run up. But I think what happens is you have people looking at it eventually, unfortunately late, but they look at gold and they eventually see it at, we're at say 26, 2,700 right now. When it gets to maybe 4 or 5,000, we're already more than halfway there. Uh, Maybe even at 3,000. These psychological levels are have a lot of impact. People will start looking at it and saying, maybe I should own some gold. But wow, gold's really expensive. It's $3,000 for an ounce. Geez, what else is there? What else can I buy? And then they'll look at silver and they'll see that at that point, if gold is 3,000, maybe silver is $40 an ounce. And they'll say, I can get a lot more silver for my money than I can for gold. And I think that's what happens. So you get this FOMO, this fear of missing out. It comes a little bit later in the cycle, and people start to pile into silver. And remember, silver is a market that is probably 1/10 the size of gold, the physical silver market. So it takes a lot less money to move silver prices. And if you think that, can be crazy and volatile, think about a very, very small handful of silver companies. And I'm talking everything from really small exploration companies and all the way up to big silver producers and big royalty companies. This is a small field, a small sector. So when the money comes pouring into this sector, it's like, I'll quote a guy that, maybe depending who's listening, some will recognize the name, some won't, but a guy by the name Doug Casey who says, it's like trying to force the contents of Hoover Dam through a garden hose. you know so there's just no capacity for it. So the share prices of some of these stocks just go absolutely wild. The silver's in the name, it ends up going nuts. So you have to be careful. You don't want to buy junk, but that's what I spend my days looking for, is the best names in this space.
So there's been a ton of actually fantastic news in the junior silver space. Do you want to talk about, obviously you have your newsletter and you're the expert in silver. So tell us about some of the ones that have really piqued your interest over the last couple of months.
Sure. Well, I'm going to even start by saying that I've been saying for about a year and a half, that the sector is ripe for M&A, mergers and acquisitions, and consolidation. And we've finally started to see that happen. So in the last maybe 3 months or so, two really, really big silver deals started to happen. I'm happy and a little bit unhappy about it because it gives me fewer names to write about and to recommend. But so you've got First Majestic that went and bought Gatos Silver, which is has a fantastic project in Chihuahua State in Mexico. This produces a lot of silver, and it's primarily silver, and it throws off a lot of cash. This was exactly what I think First Majestic needed. So I'm really happy to see that happen. And then you have Kerr Mining, which is a really long run US based silver miner, and actually went and bought Silvercrest, which has been a darling of the sector for quite some time. Now, what's interesting is that until they bought Silvercrest, Kerr actually was not the biggest silver producer. They were producing a lot more gold. But by buying Silvercrest, and because Silvercrest is so silver rich in its production, and by the way, also throws off a ton of cash, that's made Kerr a lot more attractive, in my view, as a silver guy, because now their production, once this has been fully acquired and part of their new production, Silvercrest is going to help bring Kerr's overall silver production to more like about 40 to 45% revenues from silver. So that makes, in my eyes, Kerr that more interesting at this point. So I've gotten that out of the way. Besides that, What I will say is that there are a couple of companies that I like quite a bit, that I've recommended recently and have done pretty well. So one of them is actually a bit of a remediation project, or I shouldn't say a bit. It's really truly a remediation project. It's not a mining project or a typical mining project per se. This is called Cerro de Pasco, and they've been around for quite a while. They worked like crazy for about 4 years and spent millions of dollars to eventually get a permit in Peru to start tapping into and drilling what is a tailings deposit. So they're not drilling underground to look for silver. This is considered one of the world's largest above ground metals inventories. So we're talking about globally significant amounts of metal. So this includes silver, it includes gold, zinc, and lead. And they just came out with some drill results recently. And it turns out that the silver is actually about 35% richer than they thought originally.
Wow.
So prior to these results, their numbers were showing that silver represented about 26% of the overall value of the metals, and the gold represented about 12%. So if you added them together, you were at, I think, about 38% of the value of the metals was gold and silver. So I found them interesting on that basis. I prefer higher silver, but the gold made it attractive to me, and I said, I think this is worth recommending. Um, and now these higher silver numbers are likely to push the silver content even higher. And so this is the kind of project that a guy that, again, I don't know if all, but for sure some of your listeners know Eric Sprott went very heavily into Cerro de Pasco and thinks this could be a multi-hundred bagger stock. He thinks this is going to be a true cash machine. And so they have a tailings project, which is, my goodness, I think it's 400 million tons of tailings that they're going to process. Like I say, it's a remediation project. So the local and the federal government are very interested in having this move forward because they're essentially going to do a massive environmental cleanup in the process of processing these tailings and getting the metals out. So essentially everyone's on board in getting this to move forward. So yeah, I think this one's worth looking at. It's done really quite well. I think we're up about 45 or 50% in the last month and a half. It's really just, and it's very early. I think it's very attractive still at this point. The second one that I like is actually one that I just very recently added to the portfolio. It's called Kingsmen Resources. And there's actually an interesting connection with Gatos Silver, which I talked about earlier, which was bought by First Majestic. So they are also in Chihuahua State. These are former producing mines going back many years. It's very high grade silver, so silver equivalent, some gold and silver as well, but mostly silver. And we're talking about grades that go up to historically have gone up to 600 grams per ton. Very attractive. But that goes back a few decades when the last production took place. Now, one of the geologists that helped Gatos move their very significant project forward is a guy by the name Mark Pryor. Now, Mark Pryor is moving on from Gatos to First Majestic, which bought Gatos. So that's interesting. They've kept him, but he's also an advisor to this company, Kingsmen Resources. And they think they may have some kind of an analog of the Gatos project in Chihuahua State. They're not that far from them, a few dozens of kilometers away, and they're close to the city of Parral. This is a very mining-friendly state. This would be ultimately more than likely underground mining, so we don't have concerns about open pit in Mexico, which is not a resolved issue yet. Um, And so I just think that this has tremendous potential. It's got a fantastic capital structure, very low number of shares out. They raised money, so they're fully cashed up. Drills are going to be turning in the next sort of weeks or month or so. They raised the money to put it right into the ground, and it's very early stage. It's risky. They don't have discovery, but they know there's lots of silver and gold that has been produced exactly where they're looking, and they're using a lot of I guess I'm going to say recent technology to help them find the most prospective targets to drill into. So this has a ton of potential.
Do you think with the M&A and consolidation in the silver space that we're going to see those waves that we haven't seen in a long time where, everyone gets a run from it? Or do you feel it's going to be more selective this time of, the great stories, not just you have a silver stock and
I do think we're going to see those days again. Maybe not first at first, but I do think they're coming. All we need is for, and I think that's also coming, but is for general markets to roll over. I mean, they are so fully valued. The PEs on so many of the major stocks on the major indices are so fully valued. It's much easier. A lot of big, very wise fund managers are starting to get some short exposure. They just feel that this can't go on too much longer. They're willing to allocate a little bit, at least, of their capital to the potentially outsized returns they can get from this is buying insurance, really. It's buying insurance. Look at it as buying long-term puts. And if spending a little bit of money on that could have a massive outsized return, and I think once the general markets roll over, first you're going to have obviously the smart money is going to rotate into different sectors, and they're going to look for value. Obviously, they're going to look for the most undervalued sectors. Here's an interesting statistic. So a friend of mine, Tavi Costa, who does some fantastic work, very active guy. If anybody wants to follow sort of the macroeconomic view, which I think is always important, go on Twitter, look up Tavi Costa. You'll find him right away. He's very prolific, puts out a lot of fantastic, easy to understand charts with great explanations. This is a great thing for someone to, build their education on the economy side of things, financial markets and economy. So he went and he does a lot of proprietary research and went and looked at different sectors of the S&P. And he actually looked at the precious metals mining in the S&P. So it is not an official sector of the S&P index, but he's able with his tools to say, let's look at these companies within the S&P, the ones that are in the S&P, and let's treat them as though they were a subsector, if they were an index, a sub-index in the S&P or a sector within the S&P. And the the precious metals miners are the single most profitable sector you could buy today. They have 40% um, free cash flow. It's just unheard of. There is no sector within the S&P that is printing as much cash right now as the precious metals companies, the producers. So what I'm saying is that you're going to have the smart money first, of course, is going when the market rolls over. In particular, they're gonna rotate into the deep value, and there is absolutely clear deep value right there. Then, of course, it's going to trickle down. You're going to get, the more sophisticated investors after that, and then you're going to have unfortunately, the dumb money is eventually going to do it too, but it's going to do it last, and it's going to realize, and the valuations are going to have moved up a lot more. And it's at that point, to answer your earlier question, are we going to get these crazy times like we've had before with anything and everything with the name gold or with silver or gold in their name, go wild? We will. And it's at that point.
well, I love that answer, Peter. Speaking of investors, We got exciting times coming up in Vancouver. You're going to be at VRIC, you're going to be at MIF. Do you want to just quickly mention to everyone about what panels or what days they can see you at VRIC?
Let me actually pull that up to make sure I'm giving you the right information. So January, it is, I believe it's the 17th and 18th of January. I will be speaking or be around at 17th and 18th. This is going to be at the Fairmont Pacific Rim for the Metals Investor Forum. And then the next 2 days, that would be the 19th and 20th of January. I will be at and around the VRAC, which is right across the street from that, at the waterfront, the convention center there. And so I'm expecting, it's not fully booked yet or fully decided yet, but I'm expecting I'll have a couple of speaking opportunities there as well. And so, I look forward to who wants to come and learn more about resource investing in silver in particular.
Close to the end of the year when this will be released, what is your favorite story for silver for 2024?
Okay, I'll say two things. One is I think that we are going to see silver regain 35 in the first quarter next year. So $35 was my target for Q4 this year, and we hit that. We have obviously dialed back a little bit, but it did reach that level. I think we'll regain 35, and I think we're going to see 40 or 40 plus from that point onward. So at some point, Q2 onward next year, there's a decent chance we're going to see 40 to above 40. So I'm very bullish on silver for multiple reasons, most of which we touched on earlier. In terms of stories with stocks, I'm going to have to say that honestly, I think one of the most compelling ones is probably the one that I talked about earlier, Cerro de Pasco, which has this fantastic project. People need to be a little bit patient because it has, if you look at the stock chart, you'll see that it has run, but it is just such an impactful. If you look at what it's going to produce and the kind of money that this thing is likely to throw off, this is something that you want to own. You really do. I think, it's right now trading somewhere around maybe 30, 31, 32 cents for what they have. And how this project is likely to improve as we continue to see drill. By the way, they have a lot of drill results over the next weeks and months that are going to keep coming out. And I'm expecting good news overall with that. And so I think that's going to help drive a higher share price. But I think that it's still very early days for this stock. Ultimately, we could probably be looking at, I think, 5 to 10 times in that stock, very, very realistically. So I would suggest to people to do their homework, go and dig in, read their news, look at their PowerPoint corporate presentation, and try to get a good handle on what's going on there. This is one they definitely want to own.
Well, that does it for today's Exploring Mining podcast. If you'd like to be a guest or sponsor for this podcast, please contact InvestorIdeas.com. InvestorIdeas.com reminds all listeners to read our disclaimers and disclosures on the InvestorIdeas.com website. All investment involves risk, and this podcast is not meant to be an endorsement to buy or sell securities or products. To hear more podcasts, you can go to InvestorIdeas.com/audio. And a reminder, you can also hear our podcasts on iTunes, Spotify, Google Play Music, iHeart.com, TuneIn, Stitcher, Spreaker, and SoundCloud.